This is the Investment Committee of the California State Teachers Retirement System. And I want to welcome all of you today. Scott, do you want to?
For the State Controller, Ms. Evans.
Present.
For the State Superintendent of Public Instruction, Mr. Johnson.
Here.
Ms. Yamamoto.
Here.
Mr. Tang. I believe I saw. Ms. Bradford.
Here.
Ms. Erden.
Here.
Mr. Gunning.
Present.
For the State Treasurer, Mr. Ruffino.
Present.
Chairperson Prezant, you have a quorum.
Here.
If it's okay with you, Chairperson, I'll proceed now with the reading of preliminary note.
Yes, please.
The CalSTRS board meetings are live, web-streamed, video archived, and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of the agenda item the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there is not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of speakers under the age of 18 who wish to address the board, only their first name and affiliated organization may be provided, but other personal identifying information, such as their last name, age, or school, may not be shared. Since the May Teachers Retirement Board meeting, CalSTRS received a letter from CTA expressing concern that strikes and labor disputes will negatively impact CalSTRS investment returns. 46 form emails, 11 from members and 35 from non-members, asking for more, quote, directly pro-climate investments such as renewables, electric vehicles, and battery storage, end quote, and not to rely on ESG, which only considers, quote, immediate financial risks, end quote. That's all I have, Chairperson.
Thank you, Scott. Before we begin public comment, I'd just like to, first of all, welcome all of you from the public here today, especially those from Unite Hope. The issues that we had brought before us in July are very meaningful issues about which every member of this board cares a great deal. I personally would like to share with you the fact that my mother was a member of the Culinary Union and the Teamsters Union in Nevada, where I grew up. So I grew up in a union household, and my mother was a political activist, and that's why I enjoy public service so much. So I don't know, I think I can speak for all of the board members. We care very deeply about the working person. We care very deeply about the level of treatment that he or she receives. It is part of our culture on this board and in CalSTRS. And I just want you to know that there are things that we can do as board members, but we have certain rights, but we have certain prohibitions all set forth in the law. And some things that you may want us to do, we can't do. And I hope you understand that we care very much. And I'd like just to point out that we value all of your comments because we have the strong interest in workers' rights as well as fair wages and benefits and the working conditions. These principles are part of our policies here at CalSTRS. These are the principles by which we live, by which we measure our contracting parties as well. So you can be assured that any issue you bring before us will be investigated and will be followed up on. But just to add yet another layer to demonstrate our commitment, if any of you have an issue that you think that you haven't had an opportunity to let us know about, or you'd like to expand upon, you can contact our General Counsel's office. We've instructed our General Counsel to listen and take down your concerns so that we can follow up. So With that, I'd like to proceed, but I also would like to set some ground rules because our agenda here as the board that basically, or as a committee that is involved with the investments, we have a very full agenda today. And so by policy and by rules, we have 30 minutes for public comment. And I know many of you are non-English speaking. So the way we're going to deal with that, because we want to let everybody have an opportunity to speak and have their comments heard. We're going to allow, because of the number of people, 1 minute per person. And for a non-English speaking person who has a translator, the translator will also get 1 minute. And when the 1 minute is up, there will be a dinging sound, and you're going to have to stop, whether it's mid-sentence or not, because we need to move on. And I know many of you will be saying essentially the same thing. We want to hear you. Your voice should be heard. But we do have to conduct our business, and I hope you understand. We care, we're going to listen to you, and we're going to do what we can. Thank you very much. Okay, let's begin. First speaker.
Okay, our first speaker will be Alyssa.
Good morning, Chair and Investment Committee. We'll see if I can cut mine from 3 to 1, but I am very excited for you to hear from all of these hotel workers. I also am here to speak on Blackstone and labor issues, but we'll let them speak for themselves. I just wanted to provide an update to this committee on the Packers Sanitation, the slaughterhouse cleaning company that Blackstone owns. Which you all have engaged on. We appreciate that. We know that you reported that you had conversations with Blackstone after the Department of Labor found that Packers Sanitation had employed 102 children at 13 plants across 8 states in conditions of, quote, oppressive child labor. A DOL investigator told 60 Minutes, there is no way this was just a mistake, a clerical error, a handful of rogue individuals getting through. This was standard operating procedure. Despite these revelations, CalSTRS in June committed $250 million to Blackstone Capital Partners 9, Blackstone's flagship buyout fund. After continued bad...
Thank you for your comment.
Thank you for your comments.
Our next speaker will be Jefferson.
Good morning. My name is Jefferson, Californians for Community Empowerment. In addition to child labor issues and Blackstone has wreaked havoc in our communities. They've reportedly spent $56 million to acquire housing, and what they do is they raise rents. The Private Equity Stakeholder Project and the Alliance of Californians for Community Empowerment released a report in March that documents rent hikes and increased evictions by the private equity firm Blackstone Group. Blackstone now owns and manages 300,000 units of rental housing in the U.S., making it the largest landlord in the United States. Blackstone brought 5,600 housing units in San Diego County, where rents have been affordable.
Thank you for your comment. Our next speaker will be Jordan.
Mr. President, on March 2nd, you said regarding child labor at Packers that staff is pursuing this issue vigorously because this is not something that we embrace as an organization. It is part of our ESG responsibility, and we take that responsibility very seriously. Then you gave them more money. You gave them $250 million. Your commitment accounted for a quarter of Blackstone's total fundraising in Q2 2023. This was the wrong decision from a moral perspective and from a fiduciary perspective. You cannot criticize a firm on the one hand and on the other hand, open your checkbook. This is not how you hold a firm accountable. that is the largest firm in the world that employed children. Now you face ESG issues. You face risk factors from every single one of these workers sitting here today that are striking your investments. You must engage with Blackstone, and you must close your account.
Our next speaker will be Crystal.
Good morning. My name is Crystal Padilla, and I work at the Sheraton Phoenix, owned by Blackstone. I worked in this industry for years and watched my friends self-medicate due to due to the stress of the job, which resulted in substance abuse issues. It's a challenge for me to pay my rent. I don't have health care because it's too expensive at the Sheraton, and I earn too much to qualify for Medicaid. I've not been able to see a doctor in 10 years or see a therapist to address mental health issues. Over the past 5 years, I've been in 2 car accidents and have to pay for my care out of pocket. I have medical bills from these accidents, and I'm currently paying. To make matters worse, I'm not able to afford a car, and therefore I need to live close to work. But downtown housing prices have skyrocketed over the past 2 years since the pandemic. Blackstone CEO Steven Schwarzman made $1.27 billion last year. He can afford to pay my coworkers, and not enough to survive while we were working to make his company's profits. Thank you.
Thank you for your comment. Our next speaker will be Ruth, and she will be followed by her translator.
Good morning. My name is Ruth Dominguez, and I work as housekeeper at DoubleTree by Hilton in downtown LA. I was on a strike earlier this week. I can tell you it wasn't easy to decide to strike. It means not to being paid for the days we are out and not working. But it's worth it to me because I want to afford to live reasonable distance from my workplace. I want to maintain my affordable health insurance, and I want respect. We call boycott of the city of Los Angeles. We are telling convention and large events to stay away from LA hotels. We are willing to do whatever it takes to win these wages and respect we deserve. I am asking you, what will you do? What will it take for you to urge Blackstone and Advent to resolve the dispute and end the boycott? Thank you.
Thank you for your comment. Our next speaker will be Cecilia, also followed by her translator.
Muy buenos días. Mi nombre es Cecilia Alvarado y he trabajado para Holiday Inn LAX durante los 24 años como recamarera. Comparto un estudio en Campton con mi hija de 16 años. Pago $805 al mes, pero solo porque hemos vivido allí durante los últimos 15 años. No podría pagar algo similar en ningún lugar del área si lo buscarse hoy. Como madre soltera e inmigrante dependo de este trabajo y nada más de esto para mantenernos a flote. Mi hija es todo para mí. Ella es la razón por la que trabajo horas extras regularmente y me niego a conseguir un segundo trabajo de tiempo completo. Necesito pasar tiempo con ella y asegurarme de que vaya a la universidad. Me descansaron al comienzo de la pandemia COVID-19. Estuve 2 meses de baja y fui de las primeras en volver al trabajo por la antigüedad y gracias a mi contrato sindical. Sin embargo, regresamos a trabajar mucho antes de las vacunas estuvieran disponibles y el COVID mató al padre de mis hijos, por lo que yo tenía mucho miedo de contraer el...
Thank you for your comment.
Good morning. My name is Cecilia Alvarado, and I have worked at the Holiday Inn for the last 24 years as a housekeeper. I share a studio apartment in Compton with my 16-year-old daughter. I paid $105 a month for it, but it only because we've been living there for the past 15 years. I wouldn't be able to afford something similar anywhere in the area if I were able to look for it today. As a single mother and an immigrant, I depend on this job and have nothing else to keep us afloat. My daughter is the world to me. She's the reason I work overtime regularly, and I refuse to get a second full-time job. I need to be there for her and make sure that she goes on to college. But even so, we returned to work well before any vaccines were available after the pandemic. And the father of my children died from COVID. So I was especially scared catching the virus, yet I went back to work to keep my daughter and my house fed. I urge CalSTARS to tell Advent and Blackstone to resolve the labor disputes. Thank you.
Thank you for your comment. Our next speaker will be Marta, followed by her translator.
Good morning. My name is Marta Acevedo. I work in a housekeeping at Hampton Inn Hotel in Santa Monica. I'm proud of union member of United Hill Local 11. I'm fighting for fair raise because I'm a single mother and I support my daughter, 19 years old. I am so proud of her. She's in college, but college is expensive. She saved money by living with me, and we pay $1,700 a month in rent for a single-room apartment. We saving on rent. I barely make enough money each month to cover our expenses. I deserve to live without having to worry every minute wherever I will be able to make it each month. Do you know how it feels to have to weigh every expense because being 20 short means risk eviction that it's like what it is like.
Thank you for your comment. Our next speaker will be Luis, followed by the translator.
Hola, buenos días. Mi nombre es Luis Pérez y trabajo durante 30 años en el Pasadena Hilton. Y trabajo en la cocina. Soy miembro orgulloso del United Here. Quería retirarme, pero ahora tengo problemas de mi rodilla, pero decidí para aguantar esta lucha. Le prometí a mi hermana que trabajó durante 40 años y ya está retirada. Muchos de mis compañeros de trabajo son inmigrantes igual a mí. Y muchos tienen miedo de hablar, pero sé que no podemos ganar nada solo. Tenemos que mantenernos unidos tras de mis compañeros de trabajo que somos de casa, que son amas de casa y viven en Azusa. Tienen que salir de su casa a las 5 a.m. para llegar a tiempo a trabajar en el hotel. Para mí, personalmente, el seguro médico es muy importante debido a mis problemas de salud. Y desde la pandemia en mi hotel han sido muchos tiempos difíciles. Gracias.
Thank you for your comment.
Good morning. My name is Luis Perez, and I worked for 30 years at the Pasadena Hilton in the kitchen, and I am a proud member of Unite Here Local 11. I wanted to retire because I now suffer from knee problems, but I decided to stay through this fight. I made a promise to my sister, who just retired after 40 years at the hotel, that I will stay as long as it takes to win this new contract. Many of my coworkers are immigrants like me, and many feel scared to speak up, but I know that we can't win anything on our own. We have to stick together. 3 of my coworkers who are housekeepers live in Azusa and have to leave their homes at 5 in the morning to make it to work in Pasadena. That isn't right. For me personally, the health insurance is really important because of my health problems. And ever since the pandemic, it has been even harder at my hotel. That's why I got on strike, and I'm prepared to do it again for as long as it takes to win. I urge CalSTARS to tell Blackstone and Advent to resolve the labor dispute. Thank you.
Thank you for your comment. Our next speaker will be Carlos, followed by a translator.
Good morning. My name is Carlos Moreira, and I have worked at the Holiday Inn LAX as a cook for 14 years. I'm a proud member of Unite Here Local 11. This summer, my coworkers and I went on strike. We went on a strike for better benefit, living wages, humane workload, and a pension, so we may retire with dignity. For me, I went on strike because my family is struggling. I was proud to buy a house, but just a couple of years ago, I had to move out of my house and into my garage. I could not longer afford my mortgage. I had to rent out the main house just to make meet. I don't like telling people this, but I realized leading up to the strike that I was not alone. Thousands of hotel workers.
Thank you for your comment. Our next speaker will be Delbar, followed by a translator.
Bismillahirrahmanirrahim. زمانم دلبر دی زه د ارزونا د خپل فامیل سره د مهاجرت شوی یم. ما عیسوي ته درخواست کړی و. اوس فعلا د ارزونا یو اوسېدونکی یم. ما په شیرتون هوټل کې یو کال مخکې کار شروع کړی دی. د کور کرایه هره ورځ پورته ځي او زه ستونزو سره د کور کرایه ورکوم. زه د یو شتمنې کمپنۍ سره کار کوم، لیکن زه صحي بیمه نه لرم. د دې توان نه لرم چې واخلم او غواړم لږ شاته نظر وکړم. هغه وخت چې زه په خپل هیواد کې وم، ما د امریکایي قواو سره 9 کاله کار کړی دی. هغه ټولۍ چې زه یې برخه وم وجې او د هغه ټیم یو اصلي برخه د افغانستان د عملیاتو و. او کله چې امریکایي ځواکونه افغانستان پرېښود او طالبانو واکمني شو او دوی هغه خلک په نښه کوي چې امریکایي قواو سره یې کار کړی وي، او زه مجبور شوم چې هیواد پرېږدم او مهاجر شم، ځکه چې زه هم خپل ټیم سره د مهم عملیاتو کې برخه اخیستې وه.
Thank you for your comment.
My name is Dilbar. I work and I came to Arizona with my wife as a refugee from Afghanistan. I applied for SIV special immigration visa and currently I'm resident of Arizona. I start working at Sheraton downtown Phoenix 1 year ago, but rent is going higher and higher every day, and I'm struggling every single month to pay my rent. I work for Blackstone, one of the richest companies in the world, but I don't have health insurance. I want to go back to the time when I was in my country. I worked with the U.S. Armed Forces for 9 years, and for the team I worked, it's called ODA. Since the U.S. Armed Forces went out of Afghanistan, the Taliban took over the country, and they are targeting people who has worked with the U.S. Armed Forces. I had no choice, so I had to get out of Afghanistan.
Thank you for your comment. Our next speaker will be Beatrice.
Good morning. My name is Beatriz Topete. I am the Arizona Organizing Director and Vice President of Unite Here Local 11. Over 40 conventions and groups have moved events from striking hotels. Headlines continue as workers have struck the Aloft and Fairfield owned by Blackstone and 11 more hotels operated by Advent-owned Aimbridge. You have heard from many workers here from the Aimbridge-operated hotels. We also have provided packets of articles and other information for the trustees. Since Local 11 members voted 96% to authorize the strike in June, the strikes have been covered by over 1,700 separate TV, radio, and online news clips. Please tell Blackstone and Advent to resolve the labor disputes and to negotiate labor peace agreements protecting investors from labor disputes. Blackstone has responsible contract agreement with North American Building Trades covering infrastructure and the United Food and Commercial Workers Union.
Thank you for your comment. That is the conclusion of public comment for item 2.
Mr. Counsel?
I didn't mean to jump the gun, but I want to go back and approve the agenda.
I was going to do that. Yeah, thank you.
Thank you.
For those who want further information on the follow-ups that staff has made, you can contact, as I mentioned, our general counsel, and I think you'll get more information, and I hope that will put some clarity into things. So now, I missed a beat on the way in, and that is approval of the committee agenda with, and I take a motion to approve the agenda with some modification if necessary.
So moved. Second.
All in favor, say aye.
Aye.
Okay, we can proceed. Again, thank you very much for your comments. We listen. We will do our best. We'll do what we can. There are some prohibitions, but we will do what we can. Thank you. All right, the first item on the agenda is the semi-annual performance reports. And I think the general consultant is on deck. Alan, is that two of you? Oh, well, good. Alan does need the help. Thank you very much, Stephanie.
Of course. Always a pleasure to keep Alan in his place. Oh, it's gonna be a fun day.
Do you need a lawyer? Would you let us know how you did it?
That's our secret. That's why we're sitting so far apart right now. So Alan and myself will be delivering the open session report for you today before Alan bestows his wisdom upon you all and provides some contextual context to capital markets recently. As a reminder of the processes we go through, Makita conducts a review of your portfolio every 6 months. But of course, we're involved with various issues, implementation topics with your staff on a consistent basis. So if anything does arise, we are sure to make sure that you are all informed as quickly as humanly possible. But this is our opportunity to formulate our thoughts with you all. So every 6 months, we do conduct informal interviews with all of your asset class leads for the asset classes that Makita in our general consulting capacity oversee. That's inclusive of a formal RFI and a review of the performance at the asset class and total fund level. So I will hand the mic over to Alan.
Good morning, Mr. Chairman, members. Alan Emkin, Makita. It's a pleasure to be here, even after being berated by my associate. But I'm used to it. I get it at home, and so I'm very comfortable with that. Big picture. Last year, ending 6/30, was a great year for risk assets. Stocks rallied around the world. Interest rates were high. Inflation dominated almost every conversation. And the world changed. The world really changed in the last 2 years. 2 years ago, holding cash, you were terribly penalized. You got literally no return. And on an after-inflation basis, you got a negative return. Today, you get north of 4% for holding the riskless asset. That's a change. The other thing that's changed is that we went through a very, very long period of falling interest rates and globalization. We're now in a period of rising interest rates. Hopefully, they've risen to their maximums, but we don't know yet what will occur on that front. But we're going through a process of deglobalization, where people, instead of looking outward, are looking inward. And we don't know how that will impact the capital markets. But there are risks that are different today. And to your staff's credit, they're on top of it. And really, if there's one big issue to bring to your attention, it's the importance of having your staff monitor the portfolio. Our job is to oversee the staff on your behalf. But they do that, and they do it on a regular basis, and they look at an enormous level of complexity. And the portfolio and the capital markets have only gotten more complex. And they will continue to do that. Not everything's going to work. And there's one little detail I just want to raise to you before it goes back to Stephanie. And you'll be hearing from the real estate and the private equity separately. And that is, in a diversified portfolio, some things should always be doing poorly. And it's just really, really important to remember that. You don't want everything going in the same direction, which what happened in 2022, where stocks and bonds both did poorly. You want something in the portfolio to go in a different direction than the rest of the portfolio. And so when you have an asset class or a group of asset classes that doesn't perform well, yes, we need to investigate it, but it's important not to overreact because that could well be its role in the portfolio. Steph will get into some of the details. That's the big picture. I'm happy to address any questions on the macro look from our perspective. Thank you, Mr. Chair.
Alan. Stephanie?
Seeing no questions there.
Yes.
So summarizing the results from the semi-annual report, you see it pulled up on your screen here. So CalSTRS returned a positive 6.3% for the fiscal year. This matched the policy index, but lagged peers by roughly 90 basis points. Over the trailing 10 years, a more meaningful period, you can see that the fund returned 8.7% per year, outperforming that policy index by 30 basis points and outperforming peers by roughly 80 basis points per year. All quantitative and qualitative measures of the plan, in our opinion, have been satisfied by staff, and they're continuing to execute the policy at a high level, and you'll see that reflected throughout our reports. A few asset class highlights here. Your public equity and fixed income asset classes make up roughly half of the portfolio. You can see them in the fiscal year. They're outperforming by 40 and 60 basis points respectively, and they did so with less risk, and that's very important. They express strong long-term results, as you can see, over the 10-year time period, up 9.4 and 2.1% per year. The private market asset classes, that being your private equity, your real estate, and your inflation sensitive, we see some mixed absolute and relative results there in the fiscal year time period. But when we look over longer term, the 3, the 5, the 10, you can see that all of those asset classes have performed very strong, reflecting strong execution. As a reminder for RMS, this program is designed to protect CalSTRS from market and during market drawdowns. They produce uncorrelated returns while also diversifying your risk. The market rally that we've experienced over the last 12 months has created negative absolute returns, but what you should know is that this is in line with our expectations. The underperformance we are seeing here is notable. It's incurred further review by Makita and staff, and we'll talk about those specific aspects that detracted during closed session. But what I will note here is that in Makita's opinion, we feel that staff is continuing to execute at a high level. There are challenging aspects for this type of a portfolio, that being imperfect benchmarking, or in other words, the lack of a perfect comparable when you take a look at your performance. This is something that we've pointed to in the past. It's also not just an issue isolated to CalSTRS. This is an industry-wide challenge. But overall, CalSTRS portfolio has continued to produce a strong fiscal year return, and that has happened at the same time while being diversified and disciplined. So I'll pause here and see if there's any questions.
Any questions? Nothing? Okay. Anything further? Well, again, I just have one question. What is the, in your opinion, Alan and Stephanie, what do you think is the one thing that we should be extremely mindful of as we go forward in the next year?
It's really important when you sit in our seat to be humble. And there's no evidence that we have any ability to forecast the future. What we do know is where things stand today, the world is an extraordinarily uncertain place. The whole Russia-Ukraine thing, the political ideology between China and the US, political divisions domestically and abroad, really require a level of focus and attention greater than any I've seen in my career. There's so much uncertainty. And you combine that uncertainty with what we would call nothing being cheap in the capital markets. There's nothing out there that's screaming this is a great buy. So the importance of keeping a good staff, keeping them motivated, keeping them focused on risk, and you're paying more attention than ever to the risk side of the portfolio as opposed to the return side of the portfolio, in our opinion, is really the most important thing you can do.
Anything to add, Stephanie?
Yeah, the only thing I would add here, if we look at global markets, is to watch how various monetary policies impact various societies. I think, we all hope for soft landings, and we hope for that not just in the US, but also around the world. And the fact of the matter is that's likely not going to happen. We are slowing down economies. It will be interesting and important to watch how those various economies shake out over the next 12 to 18 months.
And with your permission, Mr. Chair, the pundits all said there was going to be a recession, and they were wrong. Okay, we haven't had a recession. They were forecasting it 6 months ago, and they were forecasting it a year ago. Well, now the pundits are basically saying there's not going to be a recession. I would argue that's a counter indicator. So the fact that they're all optimistic, history has proven to me that they're usually wrong. And so I would argue there's probably a greater probability of recession now than there is today than there was when they were calling for a recession a year or two ago.
Well, on that cheery note, we do have our work cut out for us, but we do have a lot of help, and we have a tremendous staff. So thank you very much, Makita.
Thank you.
Okay, let's see, we have the, next is RCLCO, Taylor and Ben, the Taylor and Ben Show. Welcome to Sacramento.
Good morning, everyone. Ben Maslin with RCLCO Fund Advisors. I'll briefly go through the performance over the last 6 months and then turn it over to Taylor to talk about the market. I do have there we go. The portfolio outperformed the benchmark over all measurable time periods shown on the slide here. We'll note that performance was negative over the past year, but still outperformed the benchmark, and that's primarily due to valuation declines resulting from rising interest rates. The income yield is still positive across the portfolio, and so this is due to capital market pressures putting down decreasing pricing. The other thing I'll note here is that that pricing is based on appraised values, and appraisers have been slow to write down values and have lagged what market values are in terms of pricing declines. So we would expect there to continue to be valuation declines over the subsequent quarters that will be reflected in your performance going forward. And that is the case for the market, the real estate market generally. It's not isolated to CalSTRS. There's a delay in the slideshow here. Okay. Well, the next item, we'll leave the performance on until it goes. And the next thing I wanted to talk about is the compliance. The portfolio is compliant across all policies. You're still slightly over allocated to real estate. If we had the slide up, you're at about 15.8% compared to a target of 15%. But with coming valuation declines, we expect you to approach the allocation target in the near term. With regards to, go to the next slide. With regards to diversification, the two items to note here are that the portfolio continues to be underweight to two of the major property types that have performed well, and we continue to expect to perform well going forward, and that's industrial and multifamily properties. And staff is aware of this. They are working on a plan to reallocate and allocate more to these property types. The other thing I'll note here is that it's shown here that there's an over allocation to office. It's a little bit nuanced in that includes an allocation to life science properties. If you isolate it out to traditional office properties, you're actually slightly under allocated to office compared to the benchmark, which is a good thing, as that is a property type that's expected to continue to underperform. And then on leverage, The loan-to-value ratio, which is what's shown here on these various line charts, did tick up recently. That's not due to the portfolio taking on a lot of leverage. It's due to valuation declines. If the value declines, that's the denominator declining, then the ratio will increase slightly. But you continue to remain conservatively leveraged, even for your higher risk portfolio, such as the opportunistic portfolio, which is beneficial in a declining value environment. And with that, I'll turn it over to Taylor to talk about the market.
Yeah, sure. And good morning, Mr. Chair, members of the board. I thought I'd just talk about two things, a risk and where the opportunities are in today's market when talking about the broad context and how CalSTRS is acting within it. So the risk is essentially, well, among the risks, one that we're paying attention to is that asset valuations in real estate, probably beyond real estate, fall further than anticipated in a higher for longer interest rate environment, which the market is increasingly anticipating, really whether or not there's a recession going forward. We're not talking about book valuations, which is what Ben already mentioned, but rather the actual transactional values of assets. To date, if you look at public markets, if you look at actual private market transactions, it looks like real estate values are down, all other things being equal, about 15 to 25%. They've stayed relatively flat in that range relative to peak for most of this year, but in a higher for longer environment where buyers anticipate higher interest rates for longer, we could see those values come down further. And that is a threat that or risk that isn't necessarily being taken into account, but something that we're monitoring very closely. On the other side of the coin, in terms of opportunity, the primary opportunity today is really to take advantage of illiquidity in private markets and in real estate specifically. And one of the ways to take advantage of that is by lending, where other lenders are on the sidelines. That's an activity that CalSTRS is involved in, of course. The other is to provide liquidity to institutions that need cash and are finding liquidity through selling the assets that are most liquid, which are really the highest quality assets within their portfolio. And today, that really means industrial and residential properties in the best markets, best submarkets, best locations that are new and so on. That's really where there is liquidity. And as I said, prices, even for those assets, are down 15 to 25% based upon the unique circumstances. And that is an opportunity that CalSTRS is taking advantage of, which really gives it the chance to position its portfolio well for the next 10 years. Speaking to Chairperson Prezant's comments, what should the board be mindful of and focused on in terms of risks and opportunities for the next year? These are essentially what I would highlight, recognizing that real estate is a long-term asset. There's really not much that you could do within the portfolio over the next year other than position it well for the coming years, and we do think that staff is highly focused on that. So with that, we'll open it up to any questions.
Mike, just until people have collect their thoughts, I'll just ask one question. Could you comment on some of the tactical steps the real estate group has taken in the last year, this 2024, in terms of investments and sales, and how they were structured and what their purpose was? Because I think that's very interesting, in line with the comments you've already made.
Yeah, absolutely. And we can probably get into more specifics in closed session, but at a high level,
yeah. Ben, you want to start with that? Sure. So with regards to investments, as Taylor highlighted, one of the best opportunities is in an illiquid environment that you provide liquidity. And with that, they've really leaned into lending in private real estate debt. And that's been highly accretive in that you can get, at this point, equity-like returns but being in the debt position of the capital stack, so you have a cushion beneath you, so it's a lower risk type of investment. And CalSTRS is one of the, among your peer institutions, one of the bigger players in that space. With regards to the other thing I want to highlight is the allocation, which is that you were over allocated to traditional office properties. You no longer are, and that's that's intentional. Where staff has been focused on liquidating those assets that they can, and taking whatever steps are necessary, such as providing financing to the buyers in order to make that asset more liquid.
Yeah, I'll just add, just on that point, we could speak for a while about the challenges in the office sector, but staff recognizes those challenges, in particular for buildings that are more or less commodity in nature, don't have differentiating features associated with them, and are essentially pursuing disposition of those at the current market pricing, even as distressed as that is, kind of with eyes wide open regarding what the challenges are in that space. And then finally, as we all know, there is just simply more limited capital available for investing. Capital for investing comes through either liquidations of properties that you no longer want to own, or in the case of CalSTRS, subscription lines and other forms of financing that have facilitated the ability to stay active when many other buyers aren't and just simply can't be. And those were steps taken in a different point in the cycle that it can now take advantage of. So tactically speaking, that's been a huge advantage as well.
Great. Thanks, Taylor. Thanks, Ben. Karen. You can just tap me. You don't have to hit the.
Hi, thanks. There's always a lot of information in here, but I was just wondering, since you talk about the more investments in the life sciences, the biological studies, issues, things like that, but then you have the different categories, and you say that office is part of that, and so. Is it because the life sciences are in the office because there's no other category for it? Are these the industry categories that one needs to do? And then because the life sciences are within, that can't fit anywhere else, they go into the office one? Yeah, I'm not sure that I understand that part.
Yeah, you're right. Life science shouldn't be part of another category. It's a different property type that behaves differently. In real estate, there's 4 major property types. That's office, apartments, retail, and industrial properties. And then you have a bunch of what are called specialty or niche property types, and that can range from anything from hotels to medical office buildings to life science properties. The benchmark categorizes life science as office, and so when we show allocations, we show the broader office category. But it has really different demand drivers. It's performing much better than traditional office buildings, and so and it doesn't have as many obsolescence threats that traditional office has.
So long story short, academics and other researchers need to categorize things in order to be able to observe patterns and so on. So they put life science in the office category in order to be able to track it and categorize it and so on. I think you'll see increasingly life science and other niche sectors broken out as they become larger segments of institutional portfolios.
Because it seems like we're going toward that area too.
Yeah, absolutely.
Thank you. All right, thank you.
Ken.
Just wanted to, I guess, follow up on that. Is that because, there's an increase in the interest in biodiversity?
So when it comes to the growth of life sciences, right. The primary drivers of that opportunity are the aging of the population in the United States and globally, as we can all appreciate. aging individuals require a great deal more healthcare, health expenditures, and so on. And so that's driving tremendous investment by venture capital, private equity in the health sciences space. And then the second is significant technological innovations that are making those types of investments worth it, that we're actually seeing results. And so in particular, post-COVID, we saw a tremendous amount of capital, both public as well as private capital, go into biosciences to improve health treatments. And that translated into significant demand for real estate in order to conduct research, laboratory tests, and so on. And that's a mega trend that we would expect to continue for the long term. The need for this type of research and therefore space in which to house the research.
Both of those questions prompt me to ask yet another question driven by technology, I think, and also the fact that I live in the great city of San Francisco. With the development of AI, how do you see if there, well, first of all, are there any unique aspects of a artificial intelligence company, firm, that would change the dynamic, like life sciences, they need bigger open floors? And then the second question is, how do you think this impacts the Bay Area?
Sure. So that's a great question. And certainly AI and companies that both create the hardware to facilitate AI as well as the software that utilizes it are the fastest growing in the world at this point. And many observers have stated that they might represent the seed to the Bay Area's comeback, similar to prior cycles that it's gone through, and there might be, we'll echo Alan. We can't predict the future, but there's probably some merit to that argument. One trend or one result that we are immediately seeing in the real estate space as a result of AI is the demand for space in data centers. So data centers, which are essentially server farms, which house all of the data that we utilize on a minute-by-minute basis, are, if you look at AI, it is increasing the use of those servers and proliferating the amount of data being utilized and processed at an exponential rate, thereby requiring a great deal more data center space. And so that's an immediate impact, is the need for those types of facilities. When it comes to office, the actual individuals doing programming as a result to AI don't require different space necessarily than what we've seen for other technology firms, but they might be backfilling some of the space that's been given up as other companies have left the market or shrunk or pivoted in different directions.
Yeah, just one quick follow-up question to that.
Where would data centers be in the categories that we have?
They're in other. They're still a relatively small property type compared to the four major property types, but they're definitely growing. As Taylor said, there's very strong demand drivers for the space. And so institutional investors have started to lean in further, and so it is a growing property type within the overall space.
Well, we should be clear, it's a relatively small category within private real estate benchmarks, but a gigantic category already within the public real estate markets.
In the REIT markets, yeah.
Jennifer.
Thank you. And Mr. Berzant's question flagged a question for me. It's really a request over time, as we're shifting as the market is to capital from the traditional, if you will, sectors of real estate to other or alternatives or niche, whatever people use different names. And as some of the traditional categories are repositioning as the use of space is changing. If you can, back to Alan's comment about risk and thinking about role in portfolio over time as you bring the reports to us, if you can continue to flag for us where there is risk or where there are uncertainties. Because traditionally real estate was this very sort of predictable demand-driven business, and I know we still use all those factors to make decisions. and are highly competent and skilled at that, but bringing the risk elements to fore for us would be helpful. Thank you.
Yeah, absolutely. Just one quick comment regarding that. I think one of our observations is that investors have, and I've heard it said that investors have oftentimes viewed real estate as a bond-like instrument where you simply invest in an asset, you collect income like you would over time, and then you hopefully sell that asset for at least as much as what you acquired it for. What I think investors have realized over the past few years as we've faced meaningful secular shifts in how real estate is being utilized, that it is essentially an operating asset. It's like private equity to a large degree, where the business itself is a building which needs to be occupied and which you want rents to grow and so on and so forth. And so that really is the primary, the risks are all operational ultimately with every real estate property type. And so we'll be sure to highlight those, particularly as the composition of the CalSTRS real estate portfolio changes, and you're taking on different operational risks than you have previously. Yeah, absolutely critical if you're operating an asset. Yeah.
Thank you. Thank you, gentlemen. And also kudos to the real estate team. Good performance. We're proud of you, and keep up the good work.
Thank you.
Thanks. Next, we have the private equity consultant performance report. John, welcome.
You notice I sat 2 seats closer to my colleague. Just want to warm him up a little bit. I'm John Haggerty with Makita Investment Group. I'm Director of Private Markets. I have 9 slides compared to Alan's 1. I hope to get through them fairly quickly, but I will try to relate my comments today to 2 other agenda items that are come up later. One is the investment policy statement, so I will pause a little bit to talk a little bit about private equity as an asset class, and particularly the risks in the asset class, and relate to that to the rewards that you get from it. I'll also take a small detour in the realm of liquidity, which I know is a topic for later on the agenda, and talk about the deployment of capital and forecasts for capital coming back, which I think are relevant to conversations that will happen later. But first, if I could go to the next slide, I want to give a little bit of context for the time period of the report that we're giving. The private equity market cooled a little bit, but I want to stress, again, for a reference point to the liquidity conversation, that's still very well functioning. And it is today, and it was during the time period for this report. But a number of things did happen that noted a cooling. The fundraising environment sometimes is a bellwether for how people are feeling or sentiment about the private equity market, and it dropped quite a bit. It was a 1/3 decline year over year. So a year ago, we were reporting numbers that were a good 1/3 higher than they were at the end of this period of time. The financing environment, this is very critical to all assets, real estate, private equity, but that deteriorated meaningfully, higher interest rates, and furthermore, less availability of debt for deals. That will translate into the amount that you can expect return-wise from private equity. And then lower transaction volume. There was a decline in deals getting done, but I do want to emphasize that it's still a well-functioning market today with deals getting done. A 28% year-over-year decline from this point a year ago. All of these things had an effect on your prices, and thus had prices in the market, and thus the returns that you see in the report. The broadest measure of pricing in the market is a multiple of EBITDA. That's, you could think about that as cash flow, free cash flow, and that figure went down from 11.5 roughly to a little bit over 10 in that period of time. So that has to translate into write-downs and the slightly negative returns that you saw for this period of time. And that's the bit of context for the numbers I'll show in the next slide. But I will pause for that last bullet, which is an industry item, which is important to all of us that are representing limited partners. The SEC adopted a whole set of rules, or they voted to send them on for further approval. that are very meaningful to the rights of limited partners. They've been watered down a little bit in the final version, and there's been a lawsuit that's been put forth by industry groups representing general partners, but we do think that is something worth talking about, perhaps in closed session. It is welcomed by and large by all limited partners and by extension welcomed by Makita Investment Group, and I think should be welcomed by the board. Here we show the returns for this period of time, and my colleague had mentioned that they're very strong on a relative basis and an absolute basis. For the periods that mean something to me, the longer term ones, the 3, 5, and 10-year positive relative both to the State Street Index and to the custom index, representing both the private equity market in the case of the custom State Street Index and relative to stocks plus 150 basis points. So very strong performance on a relative basis and an absolute basis. Here's why I want to step back a little bit and make reference to the private equity as an asset class and why one allocates. In May, you revised your targets and bumped private equity from 13 to 14% in a process that really reset your strategic targets for the next 5 years or so. Private equity together with global equity are the two return drivers for your portfolio. So it's important that they're there to drive the expected return overall for CalSTRS. Risks are often raised. The two major risks that we can't avoid is the expense of investing in this asset class and also the illiquidity. And so boards are asked with evaluating that risk and asking the question, has CalSTRS been rewarded for this? And back in 2016, we were asked that same question, and we prepared an analysis called public market equivalent analysis. The calculations are fairly complex, but the question that it seeks to answer is quite simple, and it's shown in this slide. What if you'd taken all of the same cash flows that went into the private equity program over the years and put them into the stock benchmark that you have for that program? The answer back in 2016, and this was shown in open session, was you would have had $13 billion more if you had put that into private equity versus in the stock market. We revisited that analysis, and the punchline is shown in the third bullet, which is you'd have $47 billion more relative to having invested just in the MSCI ACWI IMI. We showed two figures. One is above, which is a ratio, the 1.36. Another way to look at that is for every dollar that went into just the index or went into private market portfolio versus the index, you would have gotten $1.36. If you add the premium return of 150 basis points, that diminishes that ratio just a little bit, but it's still very compelling. You would have gotten $1.29 back for every dollar that you put into the private equity program versus putting it into that benchmark, theoretical benchmark plus 150 basis points. So very, very strong performance relative to the stock market. So the question is whether this will continue. I'll reference your own investment policy statement that is one of the items that comes up later. The reason for the premium return to stocks is there's attractive investment opportunities presented as a result of inefficient markets, longer time horizons, and advantageous corporate governance structures. Another way of translating that from the Makita perspective is there's the potential for bargains by skilled managers because of pricing inefficiencies. There's the potential for operational value add by owning the companies and having control of them. And then lastly, arguably, there can be better alignment with management teams. There's a theoretical argument that I'll dispense with entirely, but I do think it's relevant that you simply get paid for making illiquid investments. You have a very long time horizon for your pension fund, very much unlike other participants in markets, and as a result, you can sacrifice liquidity to the market and theoretically get paid for that. So I'll turn to the next slide to get into a little bit more of your performance in a granular fashion, but the main punchline is the top column, the buyout performance since inception, 13% per year since 1989, and that's 150 basis point premium over that period of time. So that's been the main driver of your performance over time, and that is a little more than 3/4 of your entire private equity program by NAV. A little more attribution here. Investment structure, the co-investment program is a very active program. It is the most dominant way of pursuing the collaborative model, working with managers, achieving fee benefits, and the results are very positive. On the 10-year, you see a return for the co-investments of 16.1% versus the broader CalSTRS private equity program of 13.7%. So 240 basis points premium return produced by the co-investment program every year over the last 10 years. This is a growing part of your portfolio. I'll talk a little bit about the actual dollars going into it a little bit later. But the co-investment exposure, as you know, has been growing year over year. It was 19% a year ago and 21% currently. So a little bit on geographic exposures. Some of your strongest outperformance has come through your non-US investments. And that's a result of a mixture of selecting well, mostly within Europe. You've been partnered with some of the best managers on pan-European strategies. And there's been a slight growth in technology tilt in this portfolio. The other aspect of outperforming with your non-US investments has been having somewhat less in non-performing or lower performing regions, such as emerging markets broadly or Asia specifically. Here's where I'll talk a little bit about liquidity. These bars show the annual deployment, and I'll start with a caveat, which is shown on the page here. Your team cannot control the ultimate vintage year designation. That happens after a commitment is made. So what you see, and it jumps off the page, is the 2021 figure of 12.8%, $12.8 billion commitment in that period of time. That's actually not the case. Your team has made commitments to what ended up being classified as a 2021 vintage year in the preceding year and in the following year. So the actual deployment is quite a bit more smooth than that. But what you see what's notable to me is $4.2 billion following 2022 of roughly $6 billion. And here I want to talk a little bit about how you're allocating to the private equity asset class. This was an interesting year. Liquidity became very valuable. You were above your target slightly for private equity. So how did your staff respond? In all the ways that you'd want them to. The commitments were reduced. The target for 2022 was a full $8 billion, and that was to be allocated $6 billion to funds and $2 billion to co-investments. And that's roughly how it happened. The same proportions were used for deployment this year, but at roughly half the amount. So that 8 went to 4, and 1 for co-investments, and 3 for fund investments. The other thing that happened, I think, is notable and been interesting to talk to staff about in closed session. A smaller private equity budget was in some ways a virtuous thing, raised the bar for the investments that were made. This forced hard decisions with certain manager relationships, either not to recommit to a manager that's of lesser conviction, reducing a commitment to a manager, or deferring some of that commitment that would have been done in this year to the next year. And overall, staff has described a very healthy, deliberative process that working with a smaller budget has had for them. The other things, of course, that your team is exploring, as you'd expect them to, in an environment where liquidity is so precious, is exploring the potential to sell portions of the portfolio. Would be very difficult to do without taking a pretty significant haircut or discount on the assets, somewhere in the order of 10 to 20%. So that would be a last resort. Also looking at borrowing options, specifically for the private equity program. And lastly, making projections for the NAV. And your team has been very active in doing that. And I'm happy to say that positive cash flow is projected for next year. to 2024, you should see more capital coming out of the private equity program than going in. And this follows a period of time when you were ramping up to get from roughly 8% to the target of 13%, because this, again, is the major return driver for the CalSTRS retirement system overall. I will also say that the projections show that for 2026, which will be here before we know it, the projection is for a positive $5 billion cash flow coming back out to the rest of the system from the private equity program. So that's fantastic. Simply say that the program was within all of the parameters with respect to diversification. And here's our summary. It was, on a relative basis, a strong period for this semi-annual report, although the market cooled a bit. Buyout segment of your portfolio drives returns at 3/4 of your NAV. The strongest alpha or outperformance within that portfolio is in the non-US space. Current NAV is about $49 billion. And that's 16% of the total fund versus, at the time of this report, the 13% target, which is now a little bit greater. And you really benefit from having an experienced large team that can create relationships and really drive, for example, the differentiated deal flow that you have in the co-investment realm. Co-investments are allocated to investors like CalSTRS at the discretion of the managers, and it is important that they have very good partners that are experienced, and you have that in your team. The one other thing that you had specifically asked for is, as a follow-up, whenever we do our semi-annual reports, is to talk about the policy changes that permitted larger co-investments to be done. And so far, that latitude that you've provided through your policy changes has yet to be used, but it is a tool in the toolbox that could be helpful, again, to partner with a manager on a larger co-investment. To be known as a group that could do that could be helpful. That latitude has yet to be used. And with that, I've concluded my report.
Thank you, John. Questions?
I'm not going to tap you.
Okay. Karen Yamamoto.
Hi, thank you. I'm always confused about the terms that are being used. And so sometimes when you say that there's going to be capital inflow, is that different than returns?
Another word I could have used is distributions from the funds in the co-investments. So when I was talking about a positive net cash flow, that was looking at the private equity program in isolation and what cash flow it would provide back to the rest of the retirement assets.
Okay.
The big difference in return is return could have two components. One is realized, which would be the cash flow, which when there'd be a transaction or income. The other is the unrealized component of return, and that is paper gains and losses. And so return could have both components, Karen.
That's why it's confusing to me. Okay.
Understandable.
Thank you. Thank you.
Any other questions? Again, thank you very much, John. It was a thorough and informative report, and we look forward to seeing you in closed session and asking some more questions in particular. Thanks. We have 10 minutes for public comment. Is there any public comment on this item? Thank you. Let's take a short break and reconnoiter here. Let's see, at let's say 10:30. Is that okay? All right. Thank you very much.
Perfect. Thank you.
Okay. We are now, come to order, please. We are now on item 4, which is the investment policy statement modernization. And Shafat And Melissa, welcome.
Thank you. Good morning, members of the board, Chairperson Prasant. I'm Shafat Hassan, your Head of Investment Performance and Compliance. Very pleased to be here today. Can you all hear me all right? Okay. In front of you, we have the Investment Policy Statement Modernization. This is an action item. We are asking you to adopt and approve the modernization today. Before we jump into the item, just wanted to give you a recap. It is strictly a modernization approach. We really worked very hard on making sure we're not changing any significant intent, thresholds, or any constraints in your existing policies. So we've been working on this for over a year, so just wanted to give you a quick recap of the timeline. We started discussing the idea of a modernization back in the middle of 2022. And then in November of 22, we brought a proof of concept to this board, got green light from you, and moved on to bring in a preliminary read in January of 23. To me, that really wasn't technically a first read, but we, along the way, asked for your feedback, made sure that we're incorporating it, and then we came back in May with the first reading. That could have been a second reading. And then today we have a second reading, which incorporates all of your feedback, hopefully addresses all of the concerns you've had along the way. So really quick, why modernize? Why are we doing this? Well, we consider ourselves to be the leaders in the industry, and we have no less expectation of our policies and governing documents. So modernizing the policy really puts us in the best in class, it's best practice. And then secondly, the new policy is nicely structured. If you look at it, it is more user-friendly, a lot of white spaces. Melissa will go into the detailed structure, but it's nicely put into themes where it's easy for a non-industry person to understand. And then the new policy also, with its links and references, reduces policy redundancy, making administrative updates more easier, reducing the time this board would be spending on administrative updates going forward. So with that, I'm going to hand it off to Melissa.
Thank you. Thank you. Good morning. I'm Melissa Duranco, and I'm an associate portfolio manager in the investment compliance area under Shafat. So we really took an ongoing collaborative approach to this modernization. We did extensive research on industry best practices and our peers. We had discussions with our key consultants, including Makita and your fiduciary consultant and your governance consultant. We've also had many discussions with our internal stakeholders and staff in the investment branch, along with our CalSTRS general counsel. So the policy, when it's adopted, it's going to represent three items. It's going to have a core components of our investment program. It's going to have strong board governance over investments, and then it's going to have a clear structure for which staff can make investment decisions. So the policy is now broken into 4 sections. So you have the governance and oversight section, which includes applicable laws and also your delegation of authority. Your investment objectives and measurements includes your 4 total policy benchmarks. Your investment risk describes various risks that may impact the portfolio. And finally, the last section includes summaries of your investment asset programs and the strategies. So in addition to the modernization, there's one administrative update that we are bringing forward today. This slide does represent a lot of words. It shows the previous IPMP total public equity benchmark and the new total public equity benchmark that will be in the IPS. And that total public equity benchmark is reflective of the changes that we've made to align with our net zero initiatives and goals. And then also what was approved in May with the global equity and CIS policy and the total public equity risk budget. Yes. So we're here today making a recommendation to adopt the investment policy statement and the modernization of the document, and then also to approve the new language to update the existing total public equity benchmark. And with that, we're happy to take any questions.
Karen?
Hi, thank you. This is a beautiful document, and as you mentioned, there's a lot of white space, so there's a lot of, it's really easy to read, but what I focused on was this one particular part that was confusing to me, and so I wanted to take your attention to 3.3.2. I'm not sure where it is on your slide, but it's in the document itself. But to me, because it had a double negative, it was confusing because I wasn't sure, because on some parts it said one thing and then the other part it said another thing, and so I was confused. So I have some other language, if that's permissible for me to say right now?
Sure.
Okay. So I was going to say that my option would be no more than 55% of the CalSTRS investment portfolio will be invested in illiquid investments. So that takes away that double negative. And since we're talking about the risk, liquidity and illiquidity, I finally got those straight anyway. So, and then so if that would be acceptable.
It seems with the nodding of the heads.
Yeah.
May the record reflect that there was a uniform nodding of the heads of the investment team.
Okay.
I was hoping the board would first accept, and then we would.
Yeah.
Well, it's nice to have your agreement as well. Is everybody good with that change?
Is everybody okay?
Okay.
All right.
Well.
And then I also want to say one more thing, that I really appreciate that, working with Shafat and Melissa about my administrative suggestions and for grammar and punctuation that will be incorporated in the document as well. So thank you very much.
Appreciate them,
Once
Karen.
a teacher, always a teacher. With any other questions? I'm willing to take.
I want to move it.
Oh, good. And Ken seconds it. There's been a motion and a second. All in favor, say aye.
Aye.
Do we need a roll call? I didn't think so. All right, done.
Yay.
Thank you. Thank you.
A lot of hard work. Thank you. The next item on the agenda is Anybody want to address this topic with public comment? Seeing none, we'll move on. Thank you. Item number 5, Liquidity Oversight Management. Scott Chan and team.
All right. Good afternoon. My name is Scott Chan. I'm the Deputy CIO, and I just wanted to provide a quick introduction to the topic today. During the asset liability study, you had Bill, Gail, Jennifer, and Karen ask questions about our liquidity oversight. And so today we begin that journey of education and discussion. I do want to make it clear that we're not making any recommendations today. Rather, what we hope to do is introduce the topic, gather your feedback, and what we'll do is take that feedback, customize a plan with our consultants, Makita, and come back with a plan to discuss this. One question that I'm asked a lot, and Chris has asked a lot, is from the board, is do we have all the tools we need to do our jobs, to assist us? Are we foregoing any opportunities? Do we need the board to act quickly? And the answer in this case is no. As you know, we have a RAC committee, so we're making those investment transaction decisions to rebalance the portfolio and keeping the investment committee and chair and vice chair abreast of those transactions. Ultimately, the goal for us is to develop a world-class portfolio and execute on our strategic asset allocation. But then the reality of the markets and the volatility hits, assets go up and down, we need to rebalance the portfolio. So where does liquidity play into this? It really helps us to achieve or can constrain achieving our investment goals which we are all aligned to. So number one, paying our benefits. Number two, avoiding selling assets at discounts. Number three, taking advantage of market opportunities. And again, and most importantly, being able to rebalance, having the liquidity and cash needs to rebalance to our strategic asset allocation. Now, this is a team that's been managing liquidity for over 30 years and maximizing our returns and targeting that strategic asset allocation. So with that, I'd like to hand it off to Geraldine. And I think we can flip forward 2 or 3 slides.
Good morning, Geraldine Jimenez. Oh, sorry. There I am, Geraldine Jimenez, Senior Investment Director, Public Markets. Usually our great staff here does that for us, so I'm in catch-up mode. Okay, so liquidity, why are we different? Well, CalSTRS, as every investor, is different, and we're providing you a couple of reasons right here. We have a unique benefit structure, right? So as you can tell over time, we're getting more negative as we're a mature pension. That is uniquely us. We work very closely with the actuaries to understand the liabilities we'll need to pay over time. We've also gone to more illiquid assets, and 2 of your consultants this morning were talking about your private assets and the need to have liquidity and the benefit that those private assets have provided to our portfolio over time. So we're uniquely structured that we have developed large teams. We can take on these type of investments, and they have been providing benefits to the portfolio over years. So how do we do this? So the next slide. So I'm going to talk a little bit just about the framework. So liquidity is broad. I think Scott talked a little bit about it today. How do we have the cash to pay benefits? And that's actually the easiest part. The more complicated part is, when are those general partners going to call the capital, right? When do we need to rebalance because the equity markets have had a large fall? How much cash do we need? So it's actually a lot of sophisticated modeling that goes into it, and Josh Jedish and the risk team spend a lot of time doing that. How much do we need? And we're projecting, we're guessing, if you will, into the future. And the pacing, there we have the private markets. What do we expect to be committing so that we have capital into the future? A lot of modeling around that. When will the general partners call it? And so all this is the governance that Scott just mentioned, our risk allocation committee. And you've heard us talk about this a lot. It's a very active committee. We meet twice during market stress periods. We meet daily, and if not more often than daily if the market's moving and we're trying to put some positions on. We have obviously the compliance team, April Wilcox team that are providing all the reporting, the oversight to ensure that we are meeting the liquidity governance that's in the policy. We're meeting all of our policy requirements. We're understanding our risk. We're making decisions all the time. Plus, sometimes we want to lean into take an opportunity. So we see opportunity in the equity markets, so we may lean into it and want to be a little overweight, or we may need to sell because we need liquidity. Or we may want to put on some more synthetic or derivative positions to quickly move and take advantage of opportunities. So we're doing all of this now within the asset classes. The other tool we use is we have some term debt, so this talked a little bit about earlier. So all of this we have been doing. We're kind of taking this, if you will, to a management 2.0, moving further along because of where we at as a unique pension plan. And I'm going to stop there, and we're happy to take any questions.
Well, thanks, Geraldine. I just wanted to make one more comment that, essentially we've been doing this for over 30 years, but we're thinking about how we can enhance how we oversee liquidity. And Geraldine talked about many of the ways staff is thinking about it, but there is a role for the board to play as we consider, and we want your guidance and feedback in enhancing some of our policies. So 2 areas in particular, we're thinking about expanding our asset allocation ranges, and number 2, the use and utilization of leverage. And so those are two things that I want to put on the radar for the board. But again, today is more about receiving your feedback, and then for us to take that feedback, work with Nikita, and develop a plan on how to educate, discuss, and get to a point where we all feel comfortable about those recommendations or future recommendations. Thank you. So now we'll take questions. Or Alan?
Alan?
Really quickly. First, that the issue of liquidity and leverage is being discussed at almost every single one of my clients for a whole variety of reasons. So this exercise is not unique to CalSTRS. The second thing, and I'm going to enhance Geraldine's comments, she used the term guessing in terms of the cash flow, and I prefer to say it's informed opinions. And I just think, number one, that's more accurate, but it's also a more polite way of describing it.
A consultant. Always. Thank you, Alan. Mr. Gunning.
Thank you, Mr. Chair. Geraldine, in the write-up, it talked about cash flow going from $4 billion to $18 billion over the next 25 years. Are you able to expand on what's driving that, or share with us why you see that large increase?
Well, it is as the pension grows and we have more retirees, although David Lamoureux, who's in the audience, is our actuary, had wanted to also let you know that our fund also is growing. So as a percent of the fund, it's still consistent. So we shouldn't get overly anxious about it. It more was just proving the point that we need to make sure we manage our liquidity. And he is in the audience, David Lamoureux, if you would like to ask any more questions on that. I won't own any of those.
Anything further, Michael? Gail.
Thank you. Just a couple things. First, I think this is really helpful. We've had a lot of conversation about this. So just a little bit of a level set that I think is helpful as we think through how we're going to create more opportunities. I think it would be helpful to talk about how just a little bit of understanding how we become a partner of choice, and this gives us more options, but that we're not foreclosing opportunities now. So when we talk about the risk of liquidity and pacing, that we're doing it now so that we continue to have those opportunities. And then I think I asked this a lot, but I think just an understanding, because this term liquidity is out there so much, that we're still managing it all the time. Obviously, we just had the report and the policy on it. So maybe just those 3 points of clarification so that we know how much we're doing going into this, and then the opportunities that a discussion like this can present.
Okay, great. No, thanks for that feedback.
We have to answer those questions.
Oh, you want to answer them today? So maybe just a quick, Mike, you want to talk a little bit about this?
So with respect to making sure that microphone. Okay. Mike DeRay, with respect to that we don't miss out on opportunities, that's what we're doing with respect to making projections, not guesses, projections of the need for capital from our partners, private equity, real estate, inflation sensitive, and now even with fixed income doing more private debt, we're rolling those all together. The SIS investments, we're rolling all those together to see what the projections are of capital needs and making sure there's some extra capital as well available to be able to take advantage of other opportunities as they come up. So with those projections, which the further they go out, we know they're going to be a little bit off. We just try to put some cushion on that. We're taking all those projections, we're handing those off to Josh and his team, and then they're laying out, okay, what would we need to do from an asset allocation standpoint with movements in the market? And all this will come back to you in some examples and stuff. And what will we need just to make any emergency investments, or do we want to borrow some money either through hedging or through long-term debt or medium-term debt? By putting all this in place, we'll see when money comes back. I think the private equity people said there's a projection that $5 billion might be coming back in 2006 from private equity. Well, we'd put that into projection as well. And then we could see, okay, what capital's going out, what capital's coming in. That is how we would come up with let's make sure that we have capital available either through allocation, leverage, or some other methodology of sales of assets to cover any need for investment opportunities.
Did that answer your question?
Yeah, I think that's really helpful. I think the other piece is in the short term, while there are some concerns, I think what's important for the board to understand is that this is kind of the longer term view of a more strategic way to think about liquidity and pacing, but that there is ongoing work to allow us to continue to be a partner of choice within our current system. I do think it's just because when we introduce a new policy, I think it's important to understand what we're doing to address it and how we can improve it moving forward. Does that make sense?
Yep. Very good.
We'll bring to the next, we'll take that and we'll bring a little bit more of both to the next discussion.
Great, thank you.
I have a question. I'm confused, and it's often, explain to me how expanding the asset allocation bands works as a potential new means of providing greater liquidity.
Josh or Jody?
I'm Josh Diedish. I'm one of the acting co-directors for the strategy and risk team. So the expansion of the bands around the ranges. So we set the long-term targets in the asset liability study, and then we have allowable ranges that we can invest in around those, and they're different for different asset classes, but generally 3% other than for global equity. And so that's our policy range that we can work in. And so as the market evolves, and particularly when we get into periods of distress, markets can move pretty quickly, and we can move around in those ranges and move out of them potentially. And so by expanding the allowable range, it allows us a little bit more flexibility to manage the portfolio and kind of stay within policy. And given everything we've talked about with the risk allocation committee and all of the enhancements that we're making in oversight, that would be we think we can manage the risk of the portfolio and have that flexibility.
Again, it's an oversight question. So those bands, that flexibility we provide, the board, annually, or maybe not, I think it is, no, what is it, quarterly, or every 4 years, right? Every 4 years, we approve the band. And so now you're looking at the potential of expanding it. So there would be, this would be brought before us, and okay, got it. I just want to make sure that I understand. Chris.
If I can give you some history, I think it would help. Bringing you back to 2001 or 2, when I got here, I recommended we narrow the bands from 5% to 3%. Egotistically, I thought the whole industry would follow us. They did not. So it is if you read the classic textbook, Karen's been to some investment classes, almost everybody else is plus or minus 5. It just ended up becoming kind of carved in cement as the number. We think that makes sense with now in the 2020s, the volatility of the market. So we would actually be going back to an industry standard from where we started.
Thank you. Any other questions? So we look forward to more information and refinement of this. It looks like it's a great move in the right direction. It's been something that we've been talking about for the last year or so. And I want to thank you for putting all of this together. It shows a good deal of thought, and we'll work with you to get it in place. Thank you.
Thank you.
Now, is there any public comment?
There are no members of the public in the queue.
Okay. So where are we? We've got, I think, the Chief Investment Officer's report.
No, 6.
6, oh, I'm sorry. Investment Policy Revision Reference Portfolio, that's right. Oh, how did I miss that?
So just a brief bit of history. This actually started a couple of years ago in the retirement board. Scott presented that we had, over 55 benchmarks. You guys had over 35 benchmarks that you were approving. And there was a desire to simplify that especially for the teachers, the benchmarks were all customized. They're very complex. So the retirement board dealt with this in a couple of rounds. They did a survey with Makita. Then Steve McCourt and Alan did presentations to the retirement board several times last year, where we narrowed the choices down to either 4 benchmarks, 4 indexes, or just 2. And it was concluded, let's just use 2 public that the teachers can see. We spent, Bill and Harry, chair and the chair of the investment committee, chair of the retirement board, encouraged us to bring it and put it in the investment committee policy, which is why it's before you now. So that's the history. We've been looking at this issue. The benchmark for the fund is just a measurement. It's almost a discussion of, do you use standard inches or do you use metric millimeters? It's kind of like the return will be what it is, and what kind of a measuring stick do you use? And it's not very often that I have done this. As I recall, only twice in my time here, but I'm actually changing my recommendation from what's written in the memo. So it's important for the public to know that. We had come in recommending a 60-40, but having really looked at it, talked to quite a few people, and as I said, we were going back and forth all summer on this issue. 60-40 points to the standard deviation of your asset allocation. We think that's great, but no surprise. The average teacher does not understand what we mean by standard deviation of an investment portfolio. The 70-30 points to the return goal of your asset allocation. And sure enough, that's what the average teacher really understands. So I think when you're picking a reference benchmark, which is really a reference, think of it as the reference for the average teacher who wants to understand what CalSTRS is doing and how its portfolio is performing, is going to look at something close to the 7%, which is your actuarial goal. So investment staff and I am now recommending a 70-30. That was originally Makita's, they can speak for themselves. Their recommendation, it would be 70% the ACWI IMI, which I know sounds confusing, but just a global equity index, and 30% what's now called the Bloomberg Ag. It used to be a different name, but it's a fixed income aggregate, the common bond measure. And, it's funny, driving in today, I even heard the radio, they're talking about 60-40 and 70-30. They're very common phrases. And I really do think that, I often look at our portfolio as kind of representing, if you took all the teachers in California and you put them together, average age, 38, 37, or 40? That's about the kind of portfolio that a teacher should have when they're saving for their own retirement, is a 70-30. And we kind of reflect that. So this would become your main benchmark when Makita presents your semi-annual performance. You would measure against that benchmark. You'll still have, and we'll have to come up for another name for it, but what we now call the total fund benchmark, which is all your asset classes at the target weight. We'll still have that, but that'll be secondary. And that way it's not confusing to you or the public. We measure ourselves against a publicly available 70-30, and everybody can see that. So that's our recommendation. I'll let Alan speak for their recommendation.
We agree with the staff, and we want to give you the information that your staff worked diligently on this. They were open. There was real communication. At times, it was heated communication, but it was all done with well-intentioned, and I really appreciate their willingness to enter that discussion. Thank you.
Well, I want to commend everybody on working this out. There's not much difference, in 60-40, 70-30, as you said, Chris, and it does reflect what the median age of a teacher would want to invest in, and so I think it serves its purpose as a reference portfolio. Are there any questions on this item?
Me.
Okay, Karen.
In the write-up, though, it still talks about the 60-40. So do those numbers then have to change on the expected return and the expected risk then.
Right.
So, right.
What
And
I
this,
recommend, it's the first reading, so you don't have to approve it, but
Right.
if you want to, it's just a simple number changes.
Okay. That's all it is. Okay, that's all
Now
it
that
is.
you have your IPS, you have the policy words in there, you would just move the reference portfolio up and you would change it. Right now, the reference portfolio is a Morningstar target date index, which really does match what you're doing. But it's just so hard to find. You can even Google it and you can't get there easily. It's just terrible. We would just change that to this language, 70-30, and describe the indexes. And so, if you're okay with that, you can move it, but it's up to you.
Jennifer? Thank you. Great discussion, great work. Thank you. I wanted to lend my support. I don't know if others are prepared to vote, but I would be prepared to vote in favor as amended for the 70-30.
Is that a motion?
Let me ask one quick question first. It could be a motion. But I do have just one quick question, is we will have tracking error with this, as you've pointed out. And did you consider a smooth just a little bit of thought in terms of the choice of going with a smooth benchmark or one which sets us up for the tracking error and the need to always remember that at points in time where that may not signal a problem?
Yeah, I'll start, and I'm going to call on Alan, if that's okay. You're going to have huge tracking error because we invest in privates. And the reason we do, Mr. Haggerty presented earlier, is we think they will add significant value over what the public markets offer. This is an ongoing debate among CIOs and investment people is, are you better off? And our next door neighbor, Nevada, has a very simple, almost 60-40 type portfolio of just nothing but publics. Are you better off doing that, or are you better off having a big complex portfolio? We're a global, and obviously at 300 billion, massive and super complex portfolio. But I think you were reflecting to us the complexity was getting so far that the average teacher and even you were struggling to understand, like we said, 55 benchmarks, some customization. So we are measuring against something really simple that an average person, any of us could invest in that index, do it ourselves. But that means you're going to have a wide range. And there are going to be years where you underperform. I want to really caution you. Before, when I went to school, the textbook said interest rates should never go to zero. They certainly should never go negative. Well, now twice in the 2000s, in this century, the Federal Reserve has dropped interest rates to zero to avoid a recession or dampen a recession. That's just never thought of before. In those times, you're going to have a hard time beating an equity-rich benchmark because like we're seeing, real estate's kind of quiet and lagging, private equity is quiet and lagging. So the extreme environment that we're living in this century of just volatility and unusual circumstances, they'll make it tough, but that's what we discussed at the retirement board and really debated was if you want a simple one that people understand, then you're going to have to move away from the complexity of our portfolio and move over to a simple public benchmark. And smoothing it, I think they're going to present, when they present their investment report, just like they did, your benchmark is going to show 1 year, 3 year, 5 year, 10 year. And remember, we purposely put the longest time period at that first column so that your eyes get drawn right away to that, the long time period, and that will in essence smooth it. So I will always caution future boards, do not get carried away with looking at 70-30. Your mandate, number one in the Constitution, exclusive benefit of the beneficiaries. Number two, though, is keep the cost of the system low, which means not just costs, but earn the 7% actual rate of return. So you got to aim for that. And number three is diversify the assets, spread your risk. Those two things drive you away from a 70-30 to a complex portfolio. Because right now, our asset allocation in our capital market assumptions should earn over 7 and at a lower risk than a 70-30. So that's the best thing. Higher return, lower risk, that's good. And that's why you do that. And I think future boards, when they do this, while there's always lots of pressure on private equity and real estate and infrastructure, that's, they're going to have to prove that those add value and the board's going to have to look at your mandates. Alan, you want to say it more concisely?
I'm not sure I can do that, Chris. Smoothing, in my opinion, would just add complexity, but it does require explanation. And you and the public want to see what the impact is of the exposure to riskier and more expensive asset classes. And this is the only way to do it. And sometimes it's going to be one way and sometimes it's going to be another way. It's up to the consultant and the staff to explain it. But I think it's really important to show the variance and not to smooth it out, because it will be markedly significant in certain periods.
This with the understanding that it's a 70-30.
Is there a second?
I'll second.
Any discussion?
Mr. Chair, I do think just that discussion, I still think it's important that part of the reason we're doing a reference portfolio is actually because of the discussion you all just had. It is just one additional data point that the board can rely on to understand. It does not get rid of all the other benchmarks. So I do think this is a really important point, that of course there's still underlying confusion, and of course there'll be individual benchmarks. So that doesn't change. This is really just an opportunity.
Yeah, no, this is the reference portfolio under our now investment policy. Yeah.
Right.
Okay, there's been a motion and a second.
Are we voting on it? We are voting on it.
Yeah.
Okay. As amended.
As amended, yes. Let's take a roll call vote, just to have one.
Very good. Ms. Evans?
Aye.
Mr. Johnson?
Aye.
Mr. Prezant?
Aye.
Ms. Yamamoto?
Aye.
Mr. Tang?
Aye.
Ms. Bradford?
Yes.
Ms. Hendricks?
Aye.
Ms. Erden?
Yes.
Mr. Gunning? Mr. Rufino?
Yes.
Ms. Miller?
Aye.
Motion passes.
Great. Thank you very much. Again, I might just add, I want to commend staff and our consultant for getting together on this and working it out. I think this puts in place another plank in the investment policy that we needed. Thank you. Next item is the public comment. I'm sorry. Excuse me.
There is no public comment on this item.
Boom. Thank you. Is the CIO report.
Before I jump into the PowerPoint, a couple of different announcements, some introductions first. I have been here over 23 years, and I have never had the opportunity to pick my own director of real estate because Mike DeRay beat me here by about 2 months. I was pretty happy with Mike, so obviously I didn't change for 23 years. So thank you to him for all of his leadership, and congratulations on now being a senior director. But I am absolutely thrilled to introduce to you your new first ever female Director of Real Estate. Let's just say Director of Real Estate. And if she would please stand, Julie Dunnigan. Julie joined us, has been in Sacramento for a number of years, and we have known her, and Mike has just really pulled her over to recruit and bring her over to us from Franklin Templeton, and she is a huge addition to our team and a great leader, so we are so excited to have her. The other thing I usually do in July is introduce our student interns, and they've all gone back to school except for 2. So I'm going to ask them to come forward, so at least you get to meet some, and I'll name off the other students that are our internship. This had to be one of our best classes ever. It really, I say that every year, but this one was stunning. We had students, let me get it right. 2 ladies from Girls Who Invest, one from Mount Holyoke. So we had really diverse backgrounds. One from UC Irvine, Zui Swen from UC Berkeley, Stephen Fernandez, who was from NAA, New America Alliance, sponsored him. He was from UC Irvine. Innie who is from University of Miami, and she was sponsored by PRIA, which is the Real Estate Association. Wonderful lady. Madeline Shankman, rock star freshman, but she's at Wharton, the University of Pennsylvania. And then Garrett Smith, a recent grad from Cal Poly San Luis Obispo, who's here in town. So I will let these two ladies introduce themselves, their university, and then what they're going to do with their career. One. Yeah. Juliet had to leave. Yes.
Hello. Okay. Hello, it's nice to meet you all today. My name is Krupa Shah, and I'm a fourth-year student at UC Davis, studying economics. And in terms of my future career, hopefully I'll be back here next fall working for CalSTRS, and soon to, taking up. And, hopefully I have the opportunity to become the next CIO of CalSTRS. What I say? But yeah, it's been like an amazing experience being here at CalSTRS and working with like some of the best people in this industry to even begin with. I'm just super grateful to be here today and have this opportunity. Thank you so much for your time.
Yeah, go Aggies. Well, and I was psyched, and unfortunately she had to leave. We finally had, from my alma mater, UC Santa Barbara, so Juliet Casper, who was going to be a senior at UC Santa Barbara, but she had to leave already. So just an amazing student class. They were phenomenal, so diverse, amazing backgrounds, and it's interesting. We're getting, certainly always business majors that apply, but half of this group were computer science majors as well. So that really is the popular, and the fact that they were interested in investments, I thought was just awesome. So stunning group of students, and I wish you could have brought them in, but we'll find out a way to introduce them to you in the future. Other quick point, the divestment cost report, we are now changing it to correctly calling it the portfolio restrictions report. And that is in here. I have trouble with page numbers now, but it is attachment 1 to item 7. And importantly, we've broken out the different portfolio restrictions. That was a big request. I'll shout out to Park Guthrie, a teacher who's always mad at me, but that's okay. But we have broken out the divestments because they really wanted to know. They felt coal was profitable. As you can see all the way over there, and since inception, all of them have been a loss, except one. The total loss now stands at $9.5 billion. So, restrictions have not helped us. They've hurt us, except one. We call their geopolitical risk. That is the Iran divestment, the Sudan divestment, which frankly were pretty de minimis and really didn't move the portfolio. But the last restriction which was controversial for the board, we restricted 2 private prison stocks. Both of those have dropped over 50% in value. So in that area, not a big gain, but that as an investment decision, we've made a gain by restricting those. Obviously, there was a lot of concern about the social impact of those. That hasn't changed at all. They're still in operation and whatever, they're still there. But from an investment decision standpoint, I wanted you to know coal is still not profitable. It's closer, but it's still at a loss. Also on page 5 of the risk report, I wanted to highlight the top 10 country exposures. Quite surprisingly, China has dropped out of the top 10 all the way down to number 17. Our managers, most of the emerging market managers are active, meaning they get to pick the countries they want to be in. They have really reduced the exposure of China, not so much due to the rhetoric we hear out of Washington, D.C. and the anti-China talk, really just because that economy, which is the number 2 largest in the U.S. in the globe, has really slowed and has very big structural issues on debt and overbuilding and unemployment in the 18 to 25, which is pretty remarkable there. So, and it's interesting just to note that Mexico and India have jumped up into the top 10. They're only 0.6%, so really still small exposure, but I think that's pretty interesting to see. And then I want to give a shout out to Karen, once again, always giving us input. Page 7, 8, and 9 now include your top 10 money managers in every asset class. So we're showing you the percentage that manager is of an asset class. Don't compare across the charts, but just each category. That way you can see kind of who's who. And then lastly, before I go to the slides, attachment 3, twice a year you get an update on the performance, but at least annually by policy on the special mandates. And that's in there. Once every 3 years, Makita comes in with a report, which will be in the next meeting, on their observation on the special mandates, if you should revisit any of those programs, if you should look at them. It's always important to look at the since inception number or the 5 or 10 year number. These are very long programs, but I'm pleased to say that particularly the emerging manager programs are doing, in global equity, June restructured those and they're doing really well. So that's nice to see. But look at those because that's in there. There it is. PowerPoint, I will go quick. Pat Geyer's in the back, so shout out to Pat. Boy, this isn't working today. There we go. Pat, we're actually at about 313 billion. So the gain we made in the month of July, we gave back in August, and now we're pretty much flat fiscal year to date. We closed at 315 at last June 30. We're at 313 now. I feel like I'm at home. I'm like pointing the remote and work. Here's the ranges on the asset allocation. As I have told you many times, we are slightly defensive. We are worried, as Alan said, about whether you're going to have a soft landing or a difficult market. So we're limiting the movement on public equity so that we're not going to be really overweight. But we are trying to be within the ranges on everybody else close to target. So we're in essence close to home. And last year, as Alan said, was a real struggle. Well, thank you. A new battery. I appreciate that. Let's see. Wow. We were defensive all last year. We thought there was going to be a recession. I've been very clear on that. We were wrong. There was not a recession last year. And in fact, as Alan said, stocks went up 20%, 19%. So by being defensive, we didn't add any value last year, but I think we protected the trust fund, which is what you want. Just a really tough year. So Fed funds target is 2. You can see that we're significantly higher. This is inflation. Sorry, not Fed funds, inflation. That's the key stat everybody's going to watch. I would point out that oil has broken back up above 80. I think it even hit 91 this week. When inflation started to drop at the end of that graph, oil had dropped back down to 70. And WTI, West Texas Intermediate crude, doesn't immediately translate to inflation, but it's a big component. So the fact that oil has gone back up in price may start showing up in inflation maybe around November, December. We talked about the growth problems in China being the second largest economy. It will have a drag on Asia, particularly, and even Europe, which does a lot of business with China. So that is something to watch out for. If I climb up the crow's nest, same issues really worry us. I added that China's economy is slowing simply because they've been through almost 20 years of massive, rapid growth. And what happens to a country at that size when suddenly the economy doesn't keep growing at that pace? That's a significant shift. But the idea of large unemployment in that 18 to 25, that is socially a real challenge, and we'll have to see what they do. We're still kind of mixed about whether we're going to have a recession or not. We think there's likely to be one in the next 2 quarters. I would tell you always, watch the labor numbers. Every Thursday, we get new initial jobless claims. Don't pay attention to the individual weekly number. We want to look at the 4-week trend, and I'll start sending you updates on that. Board members that have been here for a while remember in the height of 08, I would send an update on that every Thursday because with the turnaround that when an economy grows, it's that Thursday jobs number. When an economy shrinks, it's that Thursday job number. So jobs matter. We worry, we focus on every month on the unemployment rate. That comes out the first Friday of a month. But the interim measure is jobless. Inevitable surprises, those are still the same. Obviously, today we worry about Russia having a deal with North Korea and resupplying them. That has not changed and still, as Alan said, a constant worry and concern. I didn't put up AI up there because I don't know that it's not a surprise anymore. And we really don't know where artificial intelligence is going to go. It may not be a risk. It may actually be a positive. But boy, you have heard, and Congress has heard loud and clear that it needs to be regulated. I know there was a huge meeting today with the U.S. Senate with leaders on AI. It's all the rage. It's all the talk. Those initials are really driving the stock market in a lot of ways. But it's just really uncertain. It's interesting to me when I think about technology. You can remember years ago, everybody raved about 3D printing. I even saw something where they were 3D printing facial bones, and that was going to be commonplace. That was like 5 years ago. Think about drones. We heard about how all our pizzas are going to be delivered by drones. So the hardware side is in autonomous cars. The hardware side is kind of sketchy and iffy and sort of works, sort of doesn't. The software side gets adopted quick, and AI is software. And the best example I can come up with is, I'll make fun of myself. In December of 2019, I had never heard the word Zoom. I now live on it. So that's a software change that, which AI may be. Now, it's been a topic, it's been out for a long time, but we'll see. That's it.
Questions, Sharon?
Thanks, Chris. I never know whether to be I never know how to react to some of your reports lately because I think there's just so many questions, and I think there's a lot of volatility and just uncertainty. So I appreciate what you're sharing. I did wonder in the, I think it's on page 5 of your report, it talks about 78% of the portfolio is invested in the US. And so I just wonder if you could, and then you're talking about the Fed looking at maybe a recession in the next 2 quarters, but then we thought there was going to be a recession last year. So can you just maybe talk to us a little bit about that exposure, 78% in the US, and then the possibility of a recession and kind of how your team is talking about that kind of moving forward, since we obviously don't know what the Fed's going to do and we don't know what the job market's going to do. How do you look at that? Like 70, that seems like a lot based in the US, so.
There we go. I hear you, Sharon. It is surprisingly consistent. If you went all the way back to when we first, because I was here when we added non-US and then emerging markets to the portfolio, we had been around 75, 25 US, non-US almost the whole time. Part of that has to do with the fact that Europe and the EU has constantly struggled for growth. And then, Asia took off, but that was really just China. China went from almost nothing in our portfolio to now where it's almost more than 40% of the emerging market index. It's huge. We pay benefits in dollars, so that's always a struggle. If it's a strong dollar environment, we like investing in the US and in US dollars. If we want diversification and we're worried about a weak dollar, then it's better to have non-US. The challenge has been that in this decade or last 2 decades, when the US catches a cold, gets a sneeze, Europe catches a cold. We've been surprised at the strength in the EU. Now that the UK has left, the UK has not done well, but the EU is okay. And then, like I said, Japan should do, demographics are against it, but Japan really has some structural opportunities to do well. And I know some CIOs that are going overweight in Japan. We still wouldn't make that much of a shift to tilt the portfolio. Most of our portfolio is locked in on indexes. So you're going to see that 78, 75% US ratio all the time. We have some active managers in June's portfolio. And then obviously in real estate and private equity, they have the chance to go abroad, particularly to the EU. But again, our interest rates, while the ECB is the European Central Bank can set their own rates, they're really going to be following the Fed's lead. And in fact, where the Fed has said they're kind of pausing taking a look. The European Central Bank under Christine Lagarde have said they're going to keep raising rates and keep fighting inflation. So it's an interesting debate. And I know, our index is primarily the U.S. in equities is about half of the world. Half of the world is the non-U.S. market. That ratio, we don't take big bets with it, but we look at it all the time, and it would be an active debate. If we thought the U.S. would have a recession that was U.S. specific, then we would seek added diversification. But we think if there's a recession here, it's going to happen around the world. Alan.
Really quickly, when you look at that number of 70-odd%, the number really isn't reflective of what's really happening at the company level. Apple's a global company. Microsoft is a global company. Their earnings come from all over the world. And on the other side, Toyota and Volkswagen are global companies. Their earnings are in dollars. So looking at those geographic parameters, that might have been true 30 or 40 years ago, and hopefully it's never true again, where the country of domicile really will dictate return.
Thank you. Any other questions? Thank you, Chris. Much appreciated. Okay. I should ask Karen where I am now, because she's always the one that keeps me in line.
Number 8.
Number 8, approval of the minutes. Any changes, Karen?
I think they were on diligence, so I think they were incorporated.
Okay. I'll take a motion to approve. Okay. All in favor, say aye.
Aye.
Okay. Next item on the agenda is, let's see here, the consent agenda approval of minutes. Report pursuant to Assembly Bill 2833. Is it?
It's all consent too.
Yeah, okay. Any changes? Consent? Okay.
Yeah, just if anyone wanted to pull it and discuss.
Anyone want to pull it? It's approved. The annual review of delegation to staff. I know it's a consent, but I have a question. I think I posed this question the other day on our call. If you look at page 2 of attachment 1, there is the inflation-sensitive provision, which provides that additional allocations or commitments may still be approved by staff, but are subject to review, this is the new language, but are subject to review by the investment committee if requested.
That's right.
And I was wondering how we could request it if you were giving them the ability to do it. So can you clear that up for me? Shafat.
Hi, Bill, again. So I think I can answer that question. This is not new language. It has been lifted from the delegation for the infrastructure component. We can definitely look at that, but the compliance team, on a monthly basis, we look at all of the policy thresholds and all of the delegations. And if there is a limit that is in the delegation document, we have checks and balances to make sure there aren't any new investments that go over the limits that are stated here.
That's reassuring, but wouldn't it be helpful to say that if it is, then why give us the subject to the review by the investment committee if we're not going to, if you're reviewing it and we're not? I don't understand. I think the language needs to be cleaned up, personally. I mean, unless you can explain to me how we have the right to do something, but you have no obligation to ask us to do it.
Yeah, and I agree, Bill. This is April Wilcox, Director of Investment Services. The language will need to be cleaned up, and I recommend that when we bring the policy back for our annual or update that we do, that we'll clean up the language. The intent was not to say that, okay,
I
good.
understand totally. But it's, it's in writing, and we have to oversee this, and if the bottom line is that this doesn't make sense. So anyway, thank you. And if it's also true for the infrastructure, that'll be cleaned up as well, I assume.
Yes,
Okay,
yes.
thank you. All right, so that'll come back to us. Review of information requests. I don't think there were any.
I did not note any.
Okay, the draft agenda for the next meeting. Would you like to sort of give us a
tee it up and give you highlights, because I can already name the big three. November is always going to be #1, our cost report. You're going to have Shafat come back and April and the team and go into detail on our investment costs, and then especially what you like to talk about is what are we saving in the collaborative model, and they will have updates and tracks and trends on that. The other, if you look at the investment committee work plan, we said that we would also do a deep dive on DE&I, and that will be a big component of the November meeting. We're going to bring in some guest speakers like you had at the offsite to talk about best practices in the industry, particularly the CFA Institute that is setting industry standards for DE&I, and we're part of that group that's developing that, but also some of our managers and leaders in that area. So I hope you really you'll see that on the November agenda and again on the January agenda. You'll see on there that on page 2, lots of different investment policies. There are 3 listed. We're probably only going to bring 2 of those, and they're first readings. They're more education. And so the big 3, without a question, are going to be that cost savings report, DE&I, and then the policy on portfolio restrictions. That may be an unusual term to you. Sharon, I'm pleased to see we are finally updating our divestment policy. And it's not going to be divestment. We're going to change the name. So we've worked with Brian, and he's been spending a ton of time on it with our fiduciary council, your fiduciary council, to rewrite that policy, and we'll bring that back for a refresher. So that's a big one. So just in your mind, like I said, we changed the divestment report to policy restrictions. So when you see that word policy restrictions, so that you all know you're talking about restricting the portfolio or divesting of something. So those will be the big 3. They really will be the dominant time we spend on it.
Okay. Seeing no questions, any public comment?
There are no members of the public in the queue.
Well, we can recess and reconnoiter, let's say, at 1 o'clock. Does that work, or would you like it 1 o'clock in closed session? And should we, Alan? I think it'd probably be best here because we're going to have, I'm sure the opportunity to have some video here or some visuals. So let's have the closed session here, and we'll be here at 1 o'clock. Thank you. Thank you, everybody. And again, thank you for Unite here for attending and providing your comments. Appreciate it. Thank you. Members of the public, the governance committee will meet at 3:15.